As a new Forex trader, we all know that you need to consider whether you are going to be a scalp trader, position trader, or a day trader. It all depends on you. So on today's video, we're going to talk about the types of traders that you need to know. And then after this video, you're going to know what kind of a trader that you need to be. I'm grabbing my own coffee here. Make sure that you grab yours because we're going to talk about a very interesting topics about different types of traders. As a Forex trader, you need to know what kind of a trader are you. We have different types of traders depending on different types of personalities that you are as a trader. So as a trader, you need to know what kind of a personality you have and what kind of a trader you can be based on your personality. So we're going to talk about 4 types of traders common, because we have different types of traders, not only 4, but I'm going to talk about only 4 that are common, that are well spoken. I'm sure you guys know them: the scalper, day trader, position trading, swing trader. Those are the 4 things that I'm going to talk about. So let's get straight to the point. So on number 1, we have scalper. Scalpers are the optimum of a short-term trader, as they specialize in profiting from small price changes and making a fast profit of reselling. Everything that we said about day traders is even more valid for scalpers, as they buy and sell at a higher frequency. Successful scalpers traders maintain a much higher ratio of winning traders versus losing ones. Usually, the average duration of a scalp trader's open position can range between a couple of seconds to a few minutes, but really longer. After a scalper can execute over 100 trades per day, you are now probably thinking of how it is even possible to buy and sell every second. The truth is that the majority of the short-term scalping strategy are facilitated by advanced computer algorithms. So as you guys must know, that a scalper is someone who's going to hold trades for just a short period of time, not for 4 hours. The maximum must be at least maybe 2 hours, if not 1 hour or less. So that's why you need to trade on time frame like 1 hour below. 1 hour is just checking whether the market is trending to the upper side or to the lower side, and then you go below to 30 minutes, 15 minutes, 5 minutes, maybe enter on the 5 minutes time frame, or maybe we can enter on 1 minute time frames, but majority of people like to enter on 1 minute time frame. So it's your choice whether you're going to enter which time frame, but then you don't hold your trades for a longer period of time. You just get inside and get out within an hour. So we look for people like who trade Abu DJ coach, who trade what do we call it, who trade fundamentals. Fundamentals can be part of scalper trading because they only get inside and get outside within a less maybe 5 minutes time. So on number 2, we have day trader. Day traders are focused on exploiting trading opportunities without leaving open position overnight. Alternatively, all their trades are open and closed within a single trading session. The average open time of a day trader position is usually less than an hour. These traders might remain open for a couple of hours. However, they are never extended into the next trading day. Day traders usually prefer more liquid instruments like stocks, Forex, and futures. These are the assets that allow them to quickly get in and out of their trades. In addition, their toolbox of strategies includes range trading, arbitrage trading, high frequency trading, noise trading, and many more. Day trading is a risky activity. It often relies on a high amount of leverage to scale the potential profit and capitalize even on the small price movement. Due to this, day trading requires an advanced understanding of market mechanics and a good risk management strategy. Furthermore, it requires substantial initial capital so that the trader can only apply more diverse techniques and specialize on the market opportunities more effectively. In brackets, although we have a hint of what we can do to start day trading with just $500. Day traders often follow the market moving event in real time to open short-term position and take advantage even of the slightest price movement. The goal of the day trader is to profit not from extend market runs but from volume. Due to this, their return might often range between 80 to 100 pips per day. A day trader is someone who's more focused on trading sessions. We have different types of sessions. We have Asian sessions, we have London sessions, we have New York sessions, and many more. We only have 4. I forgot the last one because I only trade London session and only New York session. That's the only sessions that I'm focusing on. So as a day trader, you are focusing on session. You only trade sessions. So if you open your chart, you're only going to trade between a day, 4 hour, and 1 hour. You hold your trades within a period of a day, within 24 hours or less, not more than 24 hours. That's what you need to know. So as someone who is a bit patient, not really patient, a bit patient, you have to be a day trader. I forgot to tell you that if you are a scalper, you need to be someone who's not patient enough to wait for a longer period of time to get your returns. So you want to get inside and get out, get your money, same time, not same time rather, but then in a short period of time. Number 3, we have swing trader. Swing trading is a trading style that aims to capture short and medium-term gains over an extended time frame. It is amongst the most popular forms of active trading. Swing traders look for medium-term opportunities using various forms of technical analysis. They usually hold their position open for a couple of days or even up to a couple of weeks to profit from an anticipated price move. Swing trading requires fewer efforts and time dedication than day trading. The reason is that it maximizes short-term profit potential by capturing the bulk of market swings. The essence is to successfully identify where the asset's price is likely to move next. Next, you enter a position and then capture a chunk of the profit if your market focus materialized. The most successful traders aim to capture just a part of the expected price move. Once they do, they move on to the next opportunity. They really aim at profiting from the entire market move. Instead, they prefer to make smaller but steadier returns before the market turns against them. Swing traders primarily rely on technical analysis to identify trading opportunities. Similar to day traders, they might often utilize fundamental analysis and analyze price trends and patterns to complete their strategies. So when we talk about swing trading, we talk about people who holds their trades for days or even a couple of weeks. Those people are more patient when it comes to the market. They are able to wait for days so that the market can give them what they want. They are not impatient, but they are patient enough to wait for the market to give them what they want. So as a swing trader, you need to be patient. If you are someone who's not patient enough to wait, you don't have to be a swing trader. You need to be an intraday trader, which is a day trading, and also a scalper, but most importantly a scalper, because you are not patient at all. You need to trade fundamentals. But a swing trader, you need to be patient. You need to be able to wait for days in order to get your returns. And then on number 4, we have position trader. Position traders buy assets the value of which they consider likely to appreciate in the long term. As a result, their strategies are too concerned about short-term price fluctuations. Instead, they focus on the macro trend and the growth potential of the asset. Position traders are trend followers. They identify a trend, open a position, and keep hold of it until the market movement peaks. This type of traders relies on a combination of technical and fundamental analysis tools. They keep track of macroeconomic factor and the dominant market trends. If you compare position trading with day trading, we can say that the number of trades the latter places per day often exceed the number of trades the former makes over the span of a couple of months or even year. This means that with position trading, you will be buying and selling with a much lower frequency. For example, many position traders need exceed 10 trades per year. Due to this, you also won't have to keep track of the market 24/7 or react as soon as the market moving event occurs. However, this doesn't mean you should monitor the market frequently, especially if you haven't built a proper risk management strategy from the start. The successful position trader identifies the preferred entry and exit point of, or rather for each of these intended position in advance. Once the position is open, it should be complemented with the appropriate stop loss orders. When we talk about position trading, we can say those people are investing. They are not expecting their returns in just few days. They need to hold their trades for minimum of a week, but for maximum of maybe 3 months to 4 months to get their returns. They invest their money and they let their money work for themselves. They don't work for the money works for them. So that's how smart they are. So when we talk about position traders, as we are on this topic, we're talking about people who likes to check the fundamentals that in the next 3 months to 4 months, what's going to happen with this instrument that I'm trading? Is it going to gain value or decrease in value? After finding out that they are going to increase value, that's when they go to the market and then analyze where are they going to enter the trade and then hold with proper risk management, with a proper stop loss. When they are wrong, they know that the market, once they tap onto their stop loss, they are wrong and they're going to get out of the market. So in a year, probably they take about maximum of 10 trades. So they are not always on the market looking for any opportunities like scalper trading. Scalper trading, you need to be 24/7 on your computer or on your trading station rather. And then when you talk about day trading, also you need to be there 24/7. But when you talk about swing trading, not exactly you need to be there 24/7, but you need to be there daily. Maybe you can be there 2 hours in a day and then you go back, you just keep monitoring your trades. But when we talk about position trading, we talk about people who can go to the market after a week. After a week, that's when they will go and check what's been happening. They just stay away and do and continue with their lives. So what kind of a trader are you? Are you patient or impatient? Because all four things that I've been talking about on today's video, which is scalper, day trading, swing trading, and position trading, they all depends on who are you, what kind of a personality do you have. Are you impatient or patient? If you are impatient, just try to trade to be a scalper or day trading. If you are a bit patient, be a swing trader. But if you know that bro, you are patient, just know that you need to be a swing trader. But it all depends on you. So thank you very much for tuning on this video. Make sure that you hit the subscribe button and like this video so that YouTube can recommend this video to other people.